How to build a basic momentum strategy that hedge funds use to manage billions of dollars. Explained simply, step by step. I'm Manir, also known as Ghost Trades on Twitter, and I also run Unbiased Trading, an agency where you can hire quant developers to help you backtest and automate your trading. Let's get straight into how to build a momentum strategy. One, we need to understand the market dynamics. So, financial markets are driven by the fundamental interplay of supply and demand. Momentum strategies exploit this by identifying and capturing price trends fueled by investor sentiment. So, for example, when there's a lot of fear in the markets, they tend to sell assets, pushing supply higher and potentially driving prices down. While when there's a lot of greed, this leads to increased demand, increasing and pushing up prices. And the basics of momentum is we're just trying to capitalize on this once this shift starts to begin, and we're trying to hold that for as long as possible during that momentum. Step one is identifying the trend. So the cornerstone of any momentum strategy is a robust trend measurer. So there's a couple key characteristics I normally look for. And one is smoothness. So we want to mitigate noise from the short-term price fluctuations. Two is normalization. So this ensures consistent interpretation across all asset classes. Three is positive direction bias. So ideally, the indicator should exhibit a positive value when prices are rising, for example. And we also want it to be a bit directional. So this indicator should provide a clear signal for buying or selling, just as long as it's directional based and not just range bound, for example. A couple popular versions of indicators people use is normally the ADX, so the average directional index, moving average, convergence divergence, so MACD, relative strength index, the RSI, and the rate of change, which is just the ROC. I think personally, out of all of these, I've probably used the ROC the most, and then probably actually RSI as well, a decent amount. The one we're actually going to be using in this example is the smoothed rate of change, so the SROC. This is created by combining the percentage change in price with an exponential moving average to smooth out that rate of change to make it a lot less noisy compared to the normal ROC. Step two is backtesting and validation. In equities, a higher rate of change over an X period of time often signals greater returns over the following X period. You can actually look up a couple studies on this. If I remember, I'll link them in the description as well. Yet, this rule may not apply universally across all markets. Sometimes there has been some markets where I've applied basically the same formula and it hasn't really worked very well, though I would say that is more of a rare case than a conclusion. So be sure to conduct your own linear regression test as well to validate this assumption that if there is a higher rate of change over X amount of time, it then signals the following period to also have greater returns as well. So have a look over that kind of correlation. It doesn't necessarily mean it's causation, but there's a lot of at least papers and studies on this kind of particular topic, especially on dual momentum and momentum. Step three is ranking the momentum. So this involves establishing a minimum absolute momentum threshold. For example, establishing a minimum absolute SORC value to filter out assets with weak momentum. Then you want to start sorting stocks or the assets based on the relative momentum to determine the strongest compared to the peers. For example, ranking the remaining assets based on their SORC relative to their peers. This identifies the strongest trending assets within the stock universe or whatever universe you're using for that actual asset class. Step four is portfolio construction. So this is the selection process. You're going to choose a subset of the top ranked assets, and then that will be included in your portfolio. Now, there's a key point here. So around diversification, you want to be able to balance the number of holdings to avoid overconcentration in maybe particular sectors, if that's applicable. That doesn't always need to be applicable with every momentum strategy. But the other one is a bit more important in my eyes is if you have too few number of holdings in that portfolio, you're heavily concentrating the risk. Well, if you have too many, you're basically diluting the momentum alpha. So you're just basically becoming an index. So you want a balance between those. I can't exactly tell you the perfect balance, but at least from what I've read from other experts in the space and people that have done studies, I think the golden number, if there is such a thing, would be around 10 to maybe 15 in a portfolio. You normally don't want to go higher than those because then you're diluting a lot of the time. However, that isn't applicable to every market. Most of the studies were for equities, so normal like Nasdaq, NYSE. So have a look around, see what you find, and do your own testing as well. Step 5: rebalancing the ongoing performance. So frequency is a big part of this. Periodically rebalancing the portfolio, typically on a weekly basis or according to a predefined time frame that you set or that you've backtested over. You want to then replace the assets that fall out of the top rankings with new ones that are meeting the SORC criteria or indicator or whatever measure you're using to measure that actual momentum. If you're interested in a couple other rebalancing techniques, have a read of Quantitative Momentum. It's an absolutely amazing book. It is a bit simplistic in some parts, and other parts are actually really good. I do plan to do maybe like a full thread or maybe a video about this book going into more detail, but primarily this video, encapsulates the 5 main steps that you're going to want to do for a momentum strategy. Each momentum strategy is a bit different to one another, and it really depends, at least from my experience, on the market that you're actually, choosing to deploy this on. However, definitely have this book a read. I think it's not too expensive on Amazon. I know some systematic trading books can be quite expensive because they're just a bit more niche, but I hope this helped introduce you to momentum strategies and provided you a foundation to go from. But if you found value in this breakdown, I'm running a digital lecture on developing winning strategies. We'll cover everything from idea generation to deployment using an example strategy, and the code is included. It's happening on Monday, 17th of June, but don't worry if you can't attend live. A recording of the session will also be provided, and you'll have the ability to contact me after with any questions just in case you couldn't make it. Visit the link below if you are interested.